All right, let's dig into AsiaMedic's latest annual results. On the surface, the numbers look absolutely incredible, but as any smart investor knows, you've always got to pop the hood and see what's really going on with the engine. So let's do that.
So, first off, who exactly is AsiaMedic? Well, they're a healthcare provider based in Singapore. They do things like diagnostic imaging, health screenings, that kind of stuff. And the reason we're talking about them is because their full-year numbers for 2025 just dropped, and wow, the headlines were pretty eye-popping.
And that really gets us to the heart of it, doesn't it? Their profits more than doubled. That's the kind of number that makes everyone sit up and pay attention. But the big question is this real sustainable growth? Or is there, something else going on behind the scenes?
To start, let's just look at the big, impressive numbers, the ones that got everybody talking. I mean, they really do paint a pretty amazing picture of the company's performance over the last year.
First up, revenue. We're talking over $35.2 million for the full year. That's a 22% jump from the year before. I mean, that's a really solid increase. It tells you right away that more people are using their services, which is exactly what you want to see in a growing business.
But hold on, because this is the real head turner. Profit after tax? It didn't just grow, it exploded. We're talking a 121% increase. It went from around $645,000 all the way up to over $1.4 million. Now wait a second. Your sales go up 22%, but your profit jumps 121%? That's unusual. It really makes you wonder.
Yeah, where is all this growth actually coming from? Did the company just magically become twice as efficient overnight? Or is there another factor at play? To figure that out, we've got to break down the business and see which parts are really doing the heavy lifting.
So let's do it. Let's peel back the layers and find the real growth engine here. By looking at where the money is actually coming from, we'll get a way clearer idea of what's driving these results.
And wow, okay, this chart tells a pretty simple story, doesn't it? There's one segment that's the absolute heavyweight champion here, diagnostic imaging. It's making up a massive 63% of the entire business. As you can see, everything else is barely in the same league.
And yep, this is exactly where that revenue growth came from. The diagnostic imaging division wasn't just big, it was on fire, soaring from $15.9 million to over $23 million in just 1 year. So, okay, this is the company's core engine, for sure, but it still doesn't explain that wild 121% profit jump. For that, we have to look outside of the normal day-to-day business.
And here's where we get the plot twist. It turns out that huge profit jump wasn't just from selling more medical services. Nope. There was something else, a big one-time event that seriously juiced the numbers. But, and this is key, it's not going to happen again next year.
And here it is, the big reveal. During the year, AsiaMedic made a strategic move. They sold off a majority stake in their aesthetics clinic subsidiary. And that sale created a large, one-time profit boost that significantly inflated the final numbers.
So what exactly is a one-off gain? Well, it's pretty much what it sounds like, profit from something that isn't part of your regular business. The analogy here is perfect. It's not like getting a raise at work that you'll see every year. It's like selling a valuable antique you found in your attic. It's great for your bank account this one time, but you can't count on it happening again.
Okay, so let's walk through how this all went down, step by step. First, AsiaMedic sold off 60% of their aesthetics clinic, which is called ATAC. On paper, this created a gain of about $1.9 million. But, and there's always a but, right? There was a complication. They also had to write off a $1 million loan they'd given to that same clinic. So, when you do the math, the net result, the thing that actually hit the bottom line, was a one-time boost of about $900,000.
So this leads us to the most important question for any investor looking at this company. If we just ignore that one-time gain, is the underlying business actually healthy and growing? The best way to answer that is to stop looking at accounting profits and start following the cash.
All right, time for a proper health check. We're going to look at the statement of cash flows. A lot of people say this is the truest report card for a company because it cuts through all the noise. It shows you where real hard cash came from and where it went without the confusion of non-cash accounting items like that big gain on sale. Now, the number you really want to lock in on here is that top one, cash from operations. This is the cash generated by the core, day-to-day business. And look at that jump, from $2.5 million up to $3.9 million. That is a fantastic sign. It tells you the actual business is humming along and generating more and more cash.
So if the business generated all that cash, where did it go? Well, the numbers show they put it to really good use. They spent $2.2 million on new equipment, reinvesting in that high-growth imaging business, and they also made $2.3 million in debt payments. Both are really smart moves for the long-term health of the company.
So here's the bottom line. Even when you completely ignore the one-off gain from the subsidiary sale, the cash flow statement shows that AsiaMedic's core business is fundamentally healthy and growing stronger. This is the real story that was hiding behind the headlines.
Okay, so now that we understand the real story of 2025, let's look forward. What does the road ahead look like for AsiaMedic? What are the key opportunities and, just as importantly, the risks that investors should be watching? On the opportunity side, it is all about that diagnostic imaging segment. They have a clear winner there. Their strong cash generation gives them the fuel to invest in that growth, and selling the aesthetics clinic allows them to be laser-focused. However, there are risks. The financial reports show that costs are rising across the board. Personnel, lab fees, facility costs all jumped. On top of that, their finance costs, or interest payments, are up a sharp 61%.
So, if you had to boil down the story of AsiaMedic in 2025, it would be this. It was a year of strategic focus. They cleaned house by getting rid of a non-core part of the business so they could free up resources and attention to double down on their powerhouse division, diagnostic imaging.
And that leaves us with the final big question. There's no doubt the core business is strong and growing. The cash flow proves it. But can management get a handle on those rising costs? Because in the long run, top-line growth is only valuable if you can control your expenses and make that growth truly profitable. That will be the key story to watch in the year ahead. This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.